Indian markets turned volatile early on Wednesday on a weak regional and global cues. Now that comes after a day the rupee and stocks rallied sharply on euphoria surrounding the US trade deal to lower tariffs on Indian exports. The blue chip Sensex index opened in the red but turned green soon after. Similar trends were seen in the broader Nifty index as well. The rupee too turned volatile on Wednesday after rallying against the dollar in the previous session. On Tuesday, the rupee strengthened to a 3-week high of 90.19 against the dollar. That marked its biggest single-day rise in more than 3 years, with the currency gaining over 1% during the session. The move reversed recent weakness seen amid global uncertainty, tariff concerns and risk-off sentiment. Equity markets too had a strong gap up, opening on Tuesday and held on to gains through the session. Benchmark indices surged, reflecting broad-based buying across sectors. The BSE Sensex jumped more than 2.5% to trade near 84,000 points, while the Nifty 50 climbed a similar 2.5% to around 25,770. Heavyweights across banking, energy, technology, auto and capital goods stocks led the rally. Broader markets also joined the up move, with mid-cap and small-cap indices rising close to 3% each. Sectoral indices reflected widespread optimism. Sectors with exposure to exports like auto, tech, metals and pharma posted gains. Overall, the sharp rise in the rupee and equities highlighted renewed confidence in India's macro outlook. While Indian markets turned volatile early on Wednesday on weak regional and global cues, and that comes a day after the rupee and stocks rallied sharply on the euphoria surrounding the US trade deal to lower tariffs on Indian exports. The blue chip Sensex index opened in the red but turned green soon after. Similar trends were seen in the broader Nifty index as well. The rupee too turned volatile on Wednesday after rallying against the dollar in the previous session. Now on Tuesday, the rupee strengthened to a 3-week high of 90.19 against the dollar. That marked its biggest single-day rise in more than 3 years, with the currency gaining over 1% during the session. The move has revised recent weakness seen amid global uncertainty, tariff concerns and risk-off sentiment. Equity markets too had a strong gap up opening on Tuesday and held on to gains through the session. Benchmark indices surged, reflecting broad-based buying across sectors. The BSE Sensex jumped more than 2.5% to trade near 84,000 points. And for more on this, we're now being joined by Mr. Rahul Arora, CEO, Ashika International Equities. He's joining us live from Mumbai. Welcome to the broadcast, Mr. Arora.
Morning. Thank you for having me.
Mr. Arora, do you think the market rebound can sustain and take Indian stocks to new highs?
A bit tough. I think, if you look at the US 10-year bond yield at 4.5%, it's a very lucrative asset at this point. I think as far as the foreigner is concerned, if you adjust for LTCG inflation in their own country and rupee depreciation, coupled with, like, say, a 12-13% kind of earnings growth in India, probably not the most lucrative destination right now. And the same thing applies to domestic investors. I think, if you adjust for LTCG inflation in our own country, the fact that you're getting a fixed deposit rate at 7%, post-tax, let's say 5.5%, I think the only way Indian markets can probably propel themselves higher is if the expected return is about 20% plus. And I think that confidence will only come once you have a situation where earnings projections are 15% plus. So I think we're still some, ways away from that. Could the situation change in 3 to 6 months? Perhaps. But I think right now, when you're approaching the Indian equity markets, I think it's best to do it with a little bit of cautious optimism.
Right. And how do you see foreign investors read into the deal beyond the initial reactions that we saw on Tuesday?
It's obviously a positive, the trade deal that's happened. Obviously, it's come just a day after securities transaction tax was announced. So it's obviously going to have an impact on people that do trade in F&O, and particularly on large volumes that go long and short, hedge funds, high frequency traders, so on and so forth. So it'll be an interesting counterbalancing force. But I think it's great from a sentiment point of view and a foreign direct investment standpoint. Obviously, you saw that in the rupee appreciation yesterday after a long time. But I don't think this is significantly going to alter the course of earnings for the Indian stock markets, which is why I think the resultant impact that the trade deal is going to have, particularly on earnings, won't be that much from a Nifty perspective. Mid and small caps, certainly. But like I said a little while earlier, with the US bond yield at about 4.5% 10-year, Japanese bonds looking very attractive right now. My incentive as an FI investor today to invest in India is not that hot at this point in time.
Right, we hear you. And what do you think is the most important in the US trade deal with respect to the rupee?
Well, I just think the fact that, see, obviously we have committed to $500 billion of imports over a certain period of time. But we've also slashed, our rates as far as the goods going into the US is concerned. So if this actually helps set up manufacturing in India in some way, shape or form for repatriating goods back into the United States, then like I said, you're talking about long-term foreign direct investment being created, which is not going to be fickle basis, a headline number on the Nifty. So, I would not be too carried away by the impact it would have on the rupee. I still think that the upcoming fiscal year, you will have a situation where the rupee averages about 90-91, which means you will have periods where the rupee may potentially drop down to 92, 93. But you're in a situation today where I think the government is very clear that they are more FDI focused as opposed to FII focused, and they want people to come here and set up capacities. And I think if you look at sectors like gems and jewelry, textiles, pharmaceuticals, and some of these where PLI schemes have been announced, electronics, I think these will probably stand in better stead compared to most of the others going forward.
Of course, some very interesting points there. Thank you so much, Mr. Rahul Arora, for joining us at the broadcast and putting things in perspective for us and our viewers.
Pleasure. Thank you for having me.